Hello wonderful people, this is James. Welcome to Self-Made Finance, where we teach you to be your own finance manager in a layman's language. We give you the basic financial management skills that you need to take hold of your finances. Today we want to look at the differences between T-bills and fixed deposit. I have done separate videos on these ones. I've done video on T-bills, I've done videos on fixed deposit, but in the comment section I get people asking about the differences between them. So in this video I'm going to take time to take you through the differences between them so that you can make informed decisions in case you want to go to any of them. Welcome back to Self-Made Finance, where we teach you to be your own finance manager. Like I said, we're talking about the differences between fixed deposit and treasury bills or T-bills. But before we do that, I want us to quickly look at the similarities between them, what is common to the two of them. And the first similarity is that they are both short-term investment. They don't travel beyond a year. So they are known as short-term instrument or money market instrument, so that's the basic similarity, between them. The second thing is that they are both fixed income investment or securities. And what it means is that once you invest into them, once you sign up onto any of them, the interest rate that was agreed will never change until the term of the investment, irrespective of what happens along the line on the market, the rate that was agreed upon will never change. So they are fixed income investment. The next similarity is that they are investment that are easily accessible. You don't have to struggle to invest into them. Once you have a bank account, you can just walk through and invest into them. So they are easily accessible. So these are the basic similarities between them. So let's go straight into the differences. That's the main subject of today's video, the differences between fixed deposit and T-bills. The basic difference between T-bill and fixed deposit is that whilst T-bills are investment with the government, fixed deposits are investment with a bank, So what it means is that if you invest into T-bills, you're giving your money to the government and then they pay something to you in return. But when you invest into fixed deposits, the money goes to the bank, So don't be confused about this. Somebody will say that, but I went to the bank to do T-bill. Why is it that it's going to the government? It's the government that's borrowing but going through the bank. So that's what T-bills are. So you go to the bank to do it, but the money is still going to the government. So that's the basic difference between T-bill and then fixed deposit. The money or your money goes to the government if you're investing in T-bills, but your money goes to the bank if you're investing into, fixed deposit. The next one I want to talk about is that for T-bills, the rates or the interest rate or the return you get is based on how long you want to invest it. That's the only thing that determines it. How long? If you're doing it for 3 months, if you're doing it for 6 months, if you're doing it for 1 year, based on that they determine how much you're going to earn on that. But for fixed deposits, the return you get is based on both the amount involved and the duration of how long you're doing it. So that's another difference you need to note. For fixed deposit, how much you earn it based on two things: how much is involved and how long you want to invest it. But for T-bill, how much you get or your return is based on just how long you're investing. Another difference you need to notice that, especially in Ghana, T-bills offer higher interest rate than fixed deposit. It is on rare occasions or unusual occasions that you see a fixed deposit giving you a higher return. That is when the amount is very huge. But ordinarily in Ghana, fixed deposits offer lower rates compared to T-bill. So you need to know that difference. Another thing you need to understand about both of them is that T-bills require a higher minimum requirement compared to fixed deposit. I think in Ghana currently, if you want to go into T-bills, you need to have not less than 500 Ghana cedis. But for fixed deposit, anything below that you can still, invest into that. So let's note that if you want to invest into T-bills, you need to have not less than 500 cedis. But for as low as 100 Ghana cedis, you can invest into fixed deposit. Depending on the bank, it can even be lower than that. So let's note that difference. Another thing you can notice that T-bills can be discounted. What I mean by it can be discounted is that sometimes there are situations where you can have your interest or your return before the maturity of that. So assuming you are going to have a return of 100 Ghana cedis, and you're investing maybe 1,000 Ghana cedis, you can be allowed to invest 900 cedis. At the end of the period, you get 1,000 cedis. It means that you had your 100 Ghana cedi before maturity of the investment. But fixed deposit doesn't offer that kind of option for you. So that's another thing too that you need to note. So you see, these are the basic differences between fixed deposit and treasury bills. There could be other things that we could talk about in terms of risk and all that. Whilst one is riskier, one is riskier than the other. So there could be a lot of things that we could talk about. But these are the basic differences between them. I believe once you have these differences, that can inform you whenever you want to go to any of these ones. Thank you so much for watching this episode of Self-Made Finance. God bless you.